What if you could learn in weeks what it takes the average hedge fund analyst years to learn on the job? What if you could stop guessing at what your PM wants from you or how you should be spending your time and instead feel confident you are putting your efforts in the right direction? If you want to accelerate your buy side career, the Analyst Academy from Fundamental Edge will give you the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. The Fundamental Edge Academy is taught by a veteran hedge fund analyst and PM, Brett Coffrin. Brett teaches a practical approach informed by his years of experience at some of the top funds in the world, such as Maverick Capital, D. Shaw, Citadel, and Schoenfield. Wonder how top long-term funds approach earnings season? That's covered. How will your PM expect you to add value in the first year on your job? That's covered too. Worried about what makes a good stock pitch? There's a whole module on idea generation and thesis communication. Plus, you'll get access to the Fundamental Edge alumni community, a highly engaged community which in just 1 year has grown to over 400 investment professionals. Fundamental Edge alumni get access to exclusive webinars, case studies, and an invite to their first annual Analyst Spring Training Conference in Arizona. If you want to fast track your buy side career, go to fundamentedge.com for more info. That's fundamentedge.com.
All right, hello, and welcome to Yet Another Value podcast. I'm your host, Andrew Walker, also the author of Yet Another Value blog. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on, I believe for the third time, though, second time people get the hat. I know Evan's got the hat. And
I do have the hat. I'm not wearing it, unfortunately. Yeah, sorry.
I actually have I have your hat. I told myself a couple weeks ago I'd wear it on the podcast, and I just got into my traditional thing. I'm looking around seats by my desk. But anyway, Evan Tindell. Evan, how's it going?
I'm doing well. How about yourself?
I'm doing great. Look, super excited to have you today. I knew there was passion behind this company. I didn't know quite how much passion there was till I posted on Twitter, but let me do the disclaimer and then we'll get there. Everyone should remember, nothing on this podcast is investing advice. Please consult a financial advisor, do your own work, all that type of jazz. So, Evan, the company we want to talk about today, and I'll include, you wrote it up, you did a great write-up in your Q4 letter, I believe. It wasn't Q3, it was Q4, right?
Yeah, Q4, yeah.
It did a great write-up in your Q4 letter, so I'll include a link to that in the show notes. People can check that out if they want the written word. But the company we want to talk about today is British American Tobacco. They trade in London under BATS. I believe it's BTI in the US. So I'll just toss it over to you. Who is BATS? Why are they so interesting? Why are people so passionate about them?
Sure, yeah. So they are a tobacco company, one of the largest tobacco companies in the world. I think they might be the largest or second largest in terms of revenue. And they have a large US business. They have a number of well-known brands, Kent, Dunhill, Camel, Newport, and
Lucky Strike. You got to include the Lucky Strike.
Yeah, Lucky Strike. Yeah, there's just so many brands. And I think they're in a really interesting situation because the tobacco business historically, these stocks have done really well because they tend to trade at cheap valuations. And while volume declines, they're able to typically still grow revenue like a low single digit amount by raising prices over time. And then it's all basically everything drops to free cash flow. So, you have a situation where stock trades at, 8, 9, 10 times earnings for a long period of time. And if they can buy back stock and pay a big dividend, you can see really good results, especially if the stock re-rates. Now, I think there's sort of an inflection point here for tobacco companies because of the growth in what they call reduced risk products, or some of the companies call them next generation products. And these are nicotine products that aren't tobacco typically. So, you're basically, instead of burning a bunch of leaves in your mouth, you're chewing on a pouch, or you're breathing in vapor, or you're breathing in, heated but not burnt tobacco. I guess that's also a vapor technically. I don't know what that is. I don't know what that thing is. Smoke. And so today, the stock has gone from, traded at 15 or 20 times earnings a few years ago. And today, for various reasons that we can get into, the valuation has come down a ton. It trades at, 7 times earnings, roughly 6 times, depending on, whether you're looking out a few years or what have you. And while the U.S. business, the U.S. combustibles business, like the U.S. traditional cigarettes business, is pretty challenged. And one of those major challenges is the fact that a huge percentage of the revenue comes from menthol cigarettes, which the government has talked about banning a few times. But while the U.S. business is challenged, the rest of the world has been performing pretty solidly, and they have, besides Philip Morris, they have by far the largest next generation products business, which has grown to be, around a little more than 10% of their revenue. And it's on the way to, I think, 30 to, they've given guidance that it's going to be 50% by 2030, which obviously is a, very far out guidance. So you maybe take it with a grain of salt. And so I think they're in a situation where, if you can buy this thing for 7 times earnings, and they can grow the sort of reduced risk products revenue to become a material fraction of the overall business. I personally think that tobacco companies could re-rate to 15 to 20 times earnings over the long term, as people realize that these businesses should be stable over the long term, because it's actually not the nicotine that kills you. I don't know. Most people don't realize that. I know. I think they've done surveys where the minority of people think that it's actually the nicotine that kills you, but it's actually everything else that goes into a cigarette, as well as like the burning of it in your mouth and the ash and the tar and all that stuff. So I think you have an opportunity to buy these companies as they transform from traditional tobacco companies to more normal consumer products businesses that should have a consumer products business multiple, and at least on an earnings multiple basis. BAT is, definitely one of the cheaper ones.
So it's a fascinating idea. I mean, I loved your write-up, and I'll lead the witness. My favorite part of your write-up, and where I really want to dive in a second, is I love the work you did on the next gen products and the margins that they're capable of, because that was, when I was researching, that was the first question. But let me just, we've got that to talk about. We've got ITC to talk about. We've got menthol. We've got all sorts of stuff to talk about. And I promise listeners, we're going to try and get there. But let me just start with one quick question, right? Like,
Sure.
This is a 9 to 10% dividend yield, 6 to 7 times PE company, $50 billion market cap. They put out a lot of projections. They tell you what they're going to do. Maybe they're not, they basically return all the cash to shareholders, right? It's a decently followed company. So I just want to ask, you're a former poker player. I'm always thinking about where my edge is. You're always thinking about where your edge is. Just want to ask, what do you think your edge is here, right? Like, whenever I wade into a 20 billion plus company, I'm always kind of thinking like, hey, I'm playing with the real big boys now. We're not at the poker player drunk 3 a.m. We're playing with I'm playing with Evan Tindells. I'm playing with people who know what they're doing. So what do you think your edge is when it just comes to this?
Yeah, I mean, I think historically the edge or the reason why people kind of ignore these stocks has to do with just kind of the ickiness factor or the ESG factor with respect to tobacco stocks. Like, there's just probably 30 to 50% of people out there don't want to own, I think, tobacco stocks for any reason. And that includes portfolio managers. I mean, and also this thing primarily trades in Europe, where, the ESG mandates are, I think, more stringent usually than they are in the US, which I think tends to lead to, even more dramatic gaps in valuation. And if you are interested in, the tobacco ESG story, there's just a much better stock. In fact, that's your primary concern, you buy Philip Morris, right? If that's like your main concern,
just because they're further ahead on next gen stuff, or is
yeah, exactly. They're just, they're like 40% of the business is next gen. So if that's like your main thing, you buy Philip Morris, but they trade it at 14 times earnings. So I think it seems pretty clear that that's where the kind of people are investing if they have any concern about ESG. And Philip Morris is still cheap, and it may be undervalued as well. But it's just in my blood to kind of gravitate towards whatever is a little bit cheaper.
I'm the same way. Let me ask one more stupid question, then we can dive into the real meat and potatoes of the thesis. Like, I just, Bloomberg GP or whatever, and the stock has come down from the high 30s last year to the low 30s to, basically 30, as you and I are talking. It's been a pretty bullish time for markets over the past year. It was volatile. I think people forget in October, people were despondent. But when I look at something with this steady of cash flow growth, like yields kind of having leveled off, it seems like we'll talk positive news on the ITC front. What's kind of changed over the past few months that's kind of sent the stock to the levels where I think you think it's a value?
Yeah, I mean, they've had a number of kind of short-term problems. I mean, one major one was the ban on menthol cigarettes in California that went into effect at the end of 2022. Obviously it never helps to have the regulators like just come out and ban a major product for you. And then the other thing that's happened is there's been, and I know this is like the number one concern for everyone, there's been this giant rise in disposable vapes in the US. So the US is the largest market for vaping, and their product, which is called Views, has done a really good job at taking market share from a battered and like barely existing Juul. And so they're, as far as like the legal, like FDA approved segment of the market, they have almost 40% market share. But the thing is, for the approved markets, for people that actually care about following the law and FDA regulations, you're not allowed to sell flavors.
Cotton candy.
You're not allowed to sell cotton candy. You're not allowed to sell like breakfast cereal or whatever other flavors that the companies are trying to sell. And the disposable brands, which are mostly from China, have basically said, we don't give a fuck. They're saying we're gonna keep putting out all the flavors. And that's caused them to basically take, I mean, BAT says 60% of the market. I've seen other estimates at 50%. And so what actually happened in the past year was they actually lost volume in their vape product in the US. They increased prices, so they did see a growth in revenue. But I think that, kind of the rise of the disposables has also spooked the market somewhat in terms of, the implications for the long-term value of the vaping business.
If I can just clarify for listeners to make sure I understand that they understand everything, what this is, and I've seen so much good reporting on this. What this is look, cigarettes are highly regulated, right? And vapes, all this sort of stuff, technically they should be highly regulated. And please, at the end, just tell me if I can.
I would even say technically they are highly regulated.
Yeah,
like you can't sell them. Yeah.
But what's happening is mainly from China, there are very cheap imports that, again, cotton candy, Juul 7 years ago, every kid was doing cotton candy vapes, and you generally don't want 14-year-olds getting hooked on nicotine, right? So yeah. Juul dropped it, FDA banned cotton candy, but all these Chinese imports have come in with very cheap imports, skirting all the laws. And, when you skirt the laws, it's great because you can sell people highly addictive products, and you also don't have any of the regulatory burden of following through. Like, that's just a huge cost, like not having to get is regulated spec. So they're coming in, I think they're selling mainly through like bodegas and stuff, right? So they're selling all these illegal cotton candy products, and it's just huge. And it's taking a huge share from the people who are saying, hey, we're following the regulations. It's a controlled substance. Following that, we're not selling the cotton candy. Am I kind of thinking about that correctly?
Yeah, they also sell through vape shops, which have some amount of legal products, but also just tons of illegal products. So yeah, it's a few different, but it's for sure hundreds of thousands of locations in the US.
So would this be something where if I woke up, I mean, if I was the Biden administration, I feel like this is an area of bipartisan crackdown potential, right? Like what parent is going to hear, hey, we're cracking down on cereal flavored nicotine products and selling them to underage kids or 18-year-olds and be like, oh, regulatory overreach. I don't think there's any, but if I'm into BTI, I mean, is this one of those things where I hope, I pray a year from now, 6 months from now, whenever it is, there's a, FTC, hey, we are cracking down, we're grabbing these at ports, we're putting huge fines on retailers, sell them, and the stock's up 30% because people say, oh, our regulatory nightmare is over? Is like that kind of the hope, or is there something else there?
I mean, I don't know that I have a ton of confidence that there could be one single thing that would do it.
Why not?
Because I actually don't know, because it seems like they're not able to really figure it out at customs. Like we
can stop. I mean, cocaine is
I mean, I'll say this. Yeah. So long term, it feels to me unlikely that this would be the one product that you're just able to like buy an illegal product, like no questions asked, in the store. Like there's no way that they're going to, I don't think that long term that you can just buy illegal products in like normal retail stores. But I mean, like, so the FDA has been putting out warning letters, and they've been issuing like civil monetary complaints. So the way the FDA is doing it so far is it seems like they're taking individual products like the Elf bar, or the next one was like Escobar or something. And they're like following those products to retail locations or wholesalers, and they're putting lawsuits against those retailers or those wholesalers. But there's just so many of them that they're not able to make a dent in the local supply, is what it seems. I frankly don't understand why they're not able to seize it at the border in a more systematic way.
I both believe it and I have trouble understanding it because, like, so in NYC, right before marijuana really got legalized, apparently, like, once it was decriminalized, but kind of in 2020 to 2022, decriminalized but not legalized, apparently all the bodegas, and I never do anything illegal, so I had no clue, but I heard this. All the bodegas, if you went up to them and like, hey, I want some weed, all of them would sell it to you. And what would happen is once a week, a cop would come in and say, hey, I want some weed, and they'd sell it to him. And then the cop would hit him with the $300 fine or 500, whatever it was. And all the bodegas did the math and they're like, oh, we'll just pay this fine once a week. And it's completely worth it for us to keep selling this product. And, so like, I do hear you, like, but when you say they're following them to the retailers and going and hitting them with lawsuits, like, I am surprised if I'm a bodega in New York or whatever, like, the retail is that wide open when they're hitting them with lawsuits. And like, that's a bigger crackdown than weed, which was decriminalized and everybody knew where the puck was going, versus, selling a 15-year-old cotton candy flavored Juul.
Yeah. And so if you look at like BAT's presentations, they talk about like 5 different like methods that they're trying to attack this, like the International Trade Commission, FDA warning letters and import alerts and wholesaler raids. They're talking about like trying to seize them at the border. They're talking about going through Congress. They're talking about seizures from the local police level. But it doesn't, I'm not sure exactly. I mean, I think unless, I don't know. It seems like, I feel like it's, my guess is it's going to be like kind of like a building momentum thing where like they keep broadening and broadening like the ways that they try to crack down on it. And then eventually these shops kind of realize that it's just not in their best interest to continue. And I bought a Elf bar like a month ago here in Maryland just to see. And I was like, I was like, are these like legal? Like, and the guy had no idea what I was talking about.
I was thinking the guy would respond like, okay, narc, we're not selling you this.
Yeah. Like, exactly. I was like, are you allowed to? He's like, I what?
Brett Coffrin, founder and lead trainer of Fundamental Edge, barely remembers his first year as a hedge fund analyst. Most of the year was spent in a blind panic. Was his research any good? Was he learning fast enough? What did his PM really want from him? Trading on the buy side was non-existent 15 years ago when Brett was a new analyst at Maverick Capital, and he actually got demoted. Then he worked harder, found mentors, and asked for uncomfortable feedback. Eventually, he turned it around, learning by osmosis from the talented people around him, and rose to managing director. But is this the best way to develop talent? Brett doesn't think so, and that's why he founded Fundamental Edge. The Fundamental Edge Analyst Academy provides students with the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. Lose the panic and fast track your career on the buy side. Find out more about their next cohort at fundamentedge.com.
So just sticking with the new market, one of the things, ignoring that, which is a really interesting angle to this, right? But ignoring that, so BTI comes out, and if you read their annual report, and I read their annual report in prep for this, the first thing they lead off with, they're talking about smokeless, they're talking about new categories, they're talking about the future, all that sort of stuff, right? And then the first thing that jumps out to me is, okay, cool, you're telling me you've got this great growth angle, all this stories, but the two things that jumped out to me was, one, 81% of your revenue is still from combustibles, which is legacy cigarettes, right? So all of your revenue is from legacy cigarettes. And as far as I can tell, they do not split out the margins for all of the new stuff that they do, right? Now, they did say on the 2023 earnings call, they said, hey, our new age stuff is category profitable. We hit that 2 years ahead of target. They've said that their operating margins on the new stuff is similar to cigarettes, but they haven't disclosed it. So I wanted to ask you two things, I guess three things. Number one, it's a little crazy. You know, I'm sure you're the same way when you see someone leading sexy growth story. It's like, hey, 85% of our revenue is from declining stuff. I'm like, oh, that's, but second thing is, what do you think the margins of what do you think the margins of the new stuff is? And I'm giving you a softball because, again, you did such great work. People can see it in your letter. You did such great work on busting out some other comp margins. But, you know, do you believe they can get to operating margins? Do you think there's a pot of gold at the end of this rainbow?
Yeah, I mean, I guess the first thing that I tried to think about when thinking about, because this is a big topic of debate between me and my business partner Ryan. And the first thing is, like, if you just think about the unit economics, I mean, like cigarettes are some of the most profitable products in history, obviously. And it doesn't cost much more on like a per unit basis to manufacture these things, especially at scale. And they have a benefit versus cigarettes, which is that they're much more lightly taxed generally. So they're typically able to, to retain a larger share of kind of like the retail price that you're seeing. And so that, combined with the fact that the selling price is sort of similar to cigarettes, was the first thing that I thought about when I was like, okay, well, if they can sell it for $6 and it's cost $1 to make, and the tax burden is pretty low, then okay, that seems like something that, at least, you know, from a unit economics basis, you know, it should be profitable. But then, of course, you know, you could spend, I think I said in the letter, like, you could have a gross profit positive business that is like a dogfight in terms of everything else, like marketing, and you lose all the profits on the rest of it, right? So that, obviously, that part, the second part, is a little bit tougher to kind of handicap. But what I look at is the profitability of sort of the scaled businesses that we already have, and those are primarily inside of Philip Morris. And so, you know, you could potentially criticize this analysis by saying that maybe Philip Morris's brands are better, or, you know, there's just something different about Philip Morris. But what we see with Philip Morris is basically they've scaled their IQOS business in Europe and a few other places, but primarily Europe, to, you know, basically 40% of their revenues. I mean, part of it is the Swedish Match pouch business, nicotine pouch business, but their IQOS business is, you know, maybe 30% of their revenue, and their profitability has not gotten hurt at all. In fact, they claim that it's going to continue to grow over time, their margins. And that's just for the reason I just said. You know, they sell at a similar retail price. There's a lower tax burden. The manufacturing cost at scale is lower. And while you would think that, you know, because the markets are theoretically like more open than, you know, cigarette markets, because, like, you know, for example, people talk about why cigarettes are such a good business, because people haven't been allowed to market, to like advertise for so long. So you have this kind of stagnant industry structure. And you have an oligopoly there where it's almost impossible to break in. But I think the data so far kind of shows next generation products to be similar. I mean, like, you know, in the 5 markets where BAT has strongly pushed their nicotine pouch, which is mostly like the Nordic markets, they have like giant market share. It's already profitable, and it's been tough for competitors to break in. You look at Zyn in the US, the Zyn pouches are like 80% of the market, and all competitors are struggling to break in. Like, but what I see in the next generation products is, except where the competitors are these like unregulated brands that have an advantage in terms of flavors, I find a pretty tightly regulated market in most places. And B, just not a lot of new entrants that are really gaining share. I mean, you pretty much see Philip Morris, Altria, and BAT, and that's it, except for the unregulated products. So I think that, you know, the company has basically said, you know, they said category contribution market margin of 20% last year in their top 10 markets. Now, obviously and there's a number of caveats there, right? There's like contribution margin, there's top 10 markets and all these things. But they're claiming that gross margin has gone from 35 to 56%, and that they're going to continue to kind of scale up in terms of contribution margin. But so I think my guess is that long term, if operating margin in cigarette business is 50%, I'm modeling like, just to be conservative, I'm modeling like 30%, which I think is more of like a, it's closer to like a beer margin maybe, or like a just like a good solid branded consumer products margin rather than like a cigarette margin, because it probably is going to be more open than cigarettes long term, I would guess. But I think they're going to have already, they have a pretty big advantage in terms of how long they're going to, the runway that they're developing right now.
Look, you did a great job of front running all the questions I was going to ask you, right? Because my initial worry when I look at this is okay, cool. Cigarettes have been great, but as you said, no marketing, like huge farming operations, all this sort of stuff. Nobody in their right mind is going to come in with the legal liabilities and stuff versus the new stuff. I just wanted to pull on one thread since you hit on everything I did want to ask. We just talked about how much share the non-regulated guys are taking, right? And just to explicitly say, in your mind, they're not taking share because they're like way undercutting on price or anything. They're really taking share because they are hitting the most addictive, most tasty flavors that people, kind of crave and people want, but they're the stuff that has been regulated away, in my opinion, for good reason. But they're really winning on illegal flavors, not because they're undercutting on price or any other advantage.
Yeah, I mean that's what I see. I think yeah, I mean it's like even within like, if you go to the store, even within like the Elf bars, there's like a huge difference in like how the different flavors sell, because people just love certain flavors. Like apparently Miami mint is like the number one flavor, and like everyone gets that one. But yeah, I think it's just a huge advantage to be able to have flavors. So yeah.
I'm obviously Googling Miami mint. I've never smoked a cigarette or e-cig or vapor in my life. Miami mint. I will say, man,
it looks like this. It's quite a.
Oh yeah, that's the thing that popped up in my Google. Dude, are you using the illegal flavors? This is going against.
I would never. No, I had to confirm the status of its sales in Maryland. So this is the one I bought. This is the one I bought in the store. I bought it like a couple weeks ago just to see, and the guy had no idea.
Going against it does look really cool though. Like something about that green looks cool.
Yeah, man, it's a nice packaging for sure.
One other question, just on the new categories, right? Like one of the things that both made the tobacco companies such great businesses and was a disaster for them for a while and created barriers to entries was the huge legal liabilities, right? So they had these huge legal liabilities. Effectively, they make the government into their partners. Obviously, the health risks are a lot lower with vaping and non-burn and everything, but they're not zero. And I don't think anybody started to accrue liabilities for state governments and stuff. Is there anything on the horizon with legal liabilities for these new products? Have they started even accruing anything along the lines of these, or is that just unknowable, too far out in the future?
Yeah, I think it's unknowable. I mean, yeah, if you look at like biomarkers for like various cancers or other types of health risks, it looks like the risk of all of the next gen products are way, way, way lower. Like the UK did the UK health regulators did a meta-analysis where they argued that it's at least 95% safer than cigarettes. And so I'm not super worried about that. We'll see, but I think it's unknowable right now.
No, look, it's a concern, right? Because again, all the tobacco guys, I mean, I can't remember if they went bankrupt or almost went bankrupt on these settlements, but they were big settlements, but ultimately they turned into huge margins and they kind of turned the government into your partner. You could imagine if it was like, hey, we're selling these vapes for, pick your number, $5 a pack. If it was, hey, $1 per pack goes to the government, you could imagine how that actually spurs the government to be like, hey, we're really going to start cracking down on the non-regulated stuff because we don't get anything from them and we get $1 from the regulated stuff. So you could see how that could turn it back into like this great oligopoly. So it's just,
really interesting because most people think taxes going up are bad. Yeah, in general, you'd rather pay low, but you could see how that could reintroduce huge barriers to entry here.
Yeah, and spur regulation of the illicit products. Yeah,
exactly. Let's talk. I just want to briefly talk menthol cigarettes. So you mentioned the California ban. U.S. might ban it. I know in your note you've got the two models for 2026 menthol ban versus no ban. Just want to ask, look, what is the menthol cigarette ban? Why does it hit British American Tobacco a little bit harder than their peers? And how are you thinking about that risk?
Yeah, so the menthol ban is a proposed countrywide, I almost said worldwide, but we don't have worldwide bans on things just yet. Countrywide in the US ban on menthol cigarettes that the FDA is proposing. And they basically said a number of times, like we are going to do this.
Yep.
And the reason why is because, any type of flavor, including menthol in an addictive product just makes it, it just makes it tastier. It just makes it you're more likely to get addicted. And there's some research that shows that, that younger people are more likely to get addicted to menthol.
As someone still trying to recover from the ice cream addiction of my college years, I completely understand tastier flavors result in a lot more addiction.
Yeah, you were talking about ice cream flavored Juuls, or are you talking about actual ice cream?
Oh, actual ice cream.
Ice cream. And the menthol cigarettes are also disproportionately smoked by Black Americans, which obviously any negative health impacts that come from those disproportionately affect that group. And so the FDA said we're going to ban it. They said we're going to ban it, and they pushed it back a few times. And it's a little bit controversial. Like some people are saying, some people say, well, it's from a health standpoint. It would be great for minorities in this country to have a ban on it because fewer people would smoke and fewer people would get cancer, et cetera. And then other people are like, well, yeah, maybe, but is this going to mean that like cops are going to be like, pulling over like Black drivers and like seeing a menthol like cigarette pack in their hand and arresting them, or like what actually is going to be the enforcement here? And kind of highlighting the potential for that to disproportionately affect Black people in the U.S. And so it's a little bit controversial. And my guess now that we're only whatever we are, 8 months from the election, or 9 months from the election, it seems likely to me that it gets pushed back past the election. And if it does, who knows when it might get implemented. But the ban would disproportionately affect BAT because, more than half of their U.S. revenue is from menthol cigarettes from Newports. And so if you ban that, it makes, if you ban something with $5 billion of revenue, it's just it's a tough situation to be in for a company with, only $28 billion or whatever of revenue. And so the company has said that they would retain, they plan to retain, 80+% or something of that revenue through various means, including by rebranding it as like cool and crisp flavor or something, which they've done in California to try to get around the menthol ban.
Wait, so how does that work? How does the cool and crisp flavor work?
I actually don't. You'd have to look it up. I don't think it actually has any flavor, but it's like the packaging just says like cool and crisp Newport or something, and it has the same color.
Okay, so you take the menthol out, but you just kind of try to subliminally, not even subliminally, like overtly.
I think they might claim that like the way they make the tobacco makes it like cool or something, but it's not actually flavored with menthol. I think there's like some, I don't know. I haven't smoked it, so I couldn't tell you exactly.
It's like, mint water where you put the mint tea leaves. Like when they're making these cigarettes, they soak them in like just mints and it comes out minty.
Yeah.
No, that's interesting. Let's see. Where else do I want to go?
But so, yeah, but I mean, so it's a huge risk for them. I think it's cheap enough that they can, even if it's banned, I think it's still probably cheap. But it looks to me like it's going to get pushed out. And I doubt a Trump administration bans it.
Okay, so you mentioned right at the start, right? For years, look, the best performing stocks of the past 40, 50 years are the tobacco stocks, right? If you bought Altria, Philip Morris, whatever, in the early 1970s, like you're listening to this from your own private beach. So I certainly understand that, but I do worry when you're looking and they're saying, hey, now some of this was menthol, but we're talking about like double-digit declines, volume declines in the US in 2023, offset largely by price. And some of that was menthol again, but it normalized for that, and it was probably 5 to 6% volume declines offset by price. I do start to worry, at what point do you start looping on the legacy business, right? Because again, it's still 80%. And if it disappears 30 years from now, that's one thing. If it starts, if those declines start accelerating, and I could paint you a picture where 10% pricing plus your user base dying, plus some of it switching, like it feels like we're getting there. I mean, I know I've never smoked in my life, but I know people always complain about the cigarette prices are like up 5x in the past 10 years. Like, at what point do you start doom looping on just the prices too high, fixed costs, all that type of stuff?
Yeah, that's a great question. It's unfortunately kind of unknowable. What the company will say is, if you look at, they actually talk about the affordability in the U.S. because our GDP per capita is so high. So if you look at the price of a pack of cigarettes compared to the value of someone's time in the U.S.,
Yep.
like whether it's wages or GDP per capita, it's actually relatively low compared to other places in the world. So they're claiming that gives them the ability to continue to increase prices. I have no idea if that's actually correct. And yeah, I'm pretty skeptical. I mean, we definitely, in our assumptions, we use I know some people in the comments on Twitter said that some people in the comments on Twitter said that my assumptions look a little bit aggressive. I estimate a 5% volume decline across the entire business, and a 3% price growth, so 2% net revenue declines in the traditional cigarettes business, which for the US would be probably more, because it looks like it's gonna decline faster than in other places. To me, that feels pretty conservative, but yes, but especially against last year, maybe it's not, because last year was a pretty bad year.
I was just looking to, the company took a goodwill write-off in 2000, a big goodwill write-off in 2023. And look, goodwill is non-cash. By the time they're writing off, trust me, the stock market almost always knows the goodwill write-offs. But I was just looking, it was interesting because this is a foreign company, not an American company. When they do the goodwill write-off, they disclose a lot of the assumptions behind the goodwill write-off. And I was just kind of looking, they're talking about Pall Mall, 19% 5-year volume CAGR declines, Newport, Camel, 11 to 12% volume CAGR declines. Now, that's not talking about, there's no pricing there, and some of the brands are lower than that. But I was looking at that, I was like, oh, Jesus Christ, like those are big 5-year CAGRs, So I just didn't know that was. But as you know, we're paying 7 times, 8 times free cash flow for it. Like you pay a rosy price for a rosy outlook. This is a pretty draconian price. I don't know if you want to say anything about the goodwill write-off.
Yeah, I don't have strong opinions on the goodwill write-off. I feel like those exercises tend to be, obviously it's non-cash. I don't put a ton of stock into it, but maybe it is reason to be skeptical of their claim that like in their forecast, they claim that like the traditional tobacco business is going to be flat. It's probably reason to be skeptical of that, I'd say.
Let's talk about something else. So ITC, they own this big stake in Indian tobacco. ITC, it trades in India. And it's almost funny we haven't mentioned it, because when we were doing this, it's like the ITC, it's so valuable and so big. I was like, is that actually what we should start with? But I don't know. I'll just flip it over to you. Why don't you explain what the IT stake is, the value, like how you're thinking about that?
So they so ITC is an Indian company that it used to stand for, I believe, India Tobacco Company, but
yes,
they rebranded as ITC. It's a roughly 60 billion US, I think, market cap company. And BAT owns 29% of it. And so, when you look at that, the value of that stake relative to the size of the market cap of BAT, it's like 25-30% or something of the market cap of BAT, and it doesn't really contribute that much to earnings. So because ITC trades at more than 20 times earnings, you have a situation where it certainly looks like they could return. It's a non-strategic stake. Well, that's not true. Long term, it may be a strategic stake, but it's not strategic in the sense that it's not directly helping their business right now. In terms of, it has nothing to do with their business in the U.S. or Europe or elsewhere. So when you do the math on it, I mean, it really would change the enterprise value of the company. I mean, they could pay off, more than half the debt with this, more than half of the net debt with this stake if they were able to sell it. And recently on the last conference call, they said that they were going to sell a piece of it, to kind of realize that some of that value. I mean, ITC is very interesting because they've been, they've been growing profits slowly until the last couple of years, and it's ramped up a little bit. It makes about, I mean, it's interesting because they pay a large dividend. So the dividends paid by ITC have gone from not to BAT, but just in general, have gone from $1 billion in 2018 to $2 billion today, and that's annually, and they've still been growing through that period. So, so BAT collects like 500 or 600 million of dividends from them every year, and so if they were able to if you include it in their kind of enterprise value calculation, it makes the stock look really cheap. But the more, in my opinion, because they said they were going to sell a 4% stake of their 29%. And it's not really going to be that material. Yeah.
It's so interesting because they've got this big stake, right? And it's in a high multiple company. Now, it's a high multiple company, right? I'm not saying that there's anything more to it than that. A lot of stuff in India trades for a lot higher multiple. But the three interesting angles to it were, hey, we own 29%. We think it's strategic enough. We need to keep it above 25. So we're going to sell off this 4% stake. It was very strange to me. The other thing was I saw a lot of people, and I kind of agree with this, like it's a high multiple stock, you're a low multiple stock. I saw this in the SPAC boom days, right? Once you start talking about selling down part of the stake, the stock gets hit and it's like, hey, you're going against yourself. But I know I was kind of curious, just how are you thinking about that valuation within and also, I guess the last part, taxes. Because if I remember correctly, they basically funded this business. I think they said they've been involved for 90 years. So I'm guessing their tax basis rounds to zero. Like if they did something, should we be taking a huge tax effect on it?
Yeah, that's a good point. I'm not actually sure what the tax effect would be. That's probably because I've just kind of always assumed that they weren't going to be able to sell it, and that kind of the effect on the enterprise value is not really real because they could never monetize it. But the way I account for it is I just assume that, their dividends from ITC are going to go from, 500 pounds a year to, maybe 600 or 700 pounds per year over the next, 5 years, which for the multiple of 25 times earnings to make any sense, it probably needs to, right? Like probably they need to, and they have been growing. So it makes a little bit of sense that way. So that's kind of how I think about it. I mean, in longer term, the interesting thing is, I think so. Vapes are not allowed to be sold in India right now, but it's interesting to think about if there could be some type of partnership longer term to actually, because you have a billion whatever people, a lot of whom smoke, and there's not really a good reason why the government shouldn't allow vapes into the country long term. And so it'd be, I don't know. I think the more interesting, maybe long-term result is some type of partnership where they are able to grow an Indian business, maybe if it's just selling to ITC to kind of use their vaping assets in that way.
Just the way you talked about ITC, would I be crazy if I said, obviously you're ascribing some value to BAT's ITC stake, but you're not ascribing kind of the market price of ITC to
exactly. Okay. Yeah, I think that's right. Yeah. So I'm growing the dividends in my model. I'm growing the dividends that they get from them, but I'm not like subtracting the enterprise value from the current price or subtracting the market cap of their stake in ITC from the current enterprise value or anything like that. And for me, it might happen sometime later, but in terms of monetizing that stake, but I don't think it's needed to think that BAT is cheap.
It's interesting because, I think I have had historically very little success with some of the parts stories, with one exception. And I think the exception is when you've got let's call it a legacy company that's trading for a very low multiple, and they've got a stake in a very high multiple company. And one I just pops to mind, I hadn't thought about before the podcast, but one that pops to mind, which I think you were involved with too,
is Dell with their VMware stake, right? Legacy Dell, oftentimes you could buy them for free for 1x PE if you were looking through the VMware stake. And there were lots of debates. I mean, I think people rightly or wrongly were saying, hey, part of the reason that this exists is because people do not trust Michael Dell, but that trade just worked out absolutely swimmingly. And did Michael Dell get more than his fair share of the profits of that trade? I would argue absolutely yes. But, it actually worked out really well for everyone, especially if you held all the VMW stock, because they merged with Avago, with Broadcom, ticker AVGO, and AVGO stock went up like 4x in between the merger announcement and the deal closing. So that was just a grand slam home run. But yeah, I don't know. I off the top of my head, I can't think of any examples, but I think that's the one place it's really worked. And I'm just, as we're talking it through, I'm just seeing BATS, 7x PE, ITC, huge stake, 33% of the equity cap. Like that's just it pattern matches.
My view is that some of the parts get a bad rap because they're usually done so terribly. And I don't think it actually indicts that method of analysis. It's just that what most people do is they take 4 businesses with 4 segments with like 4 different EBITDAs. They slap multiples on. They're like, oh, this is worth 12, this is worth 8, this is worth 15, and this is worth 7. And then they try to get an enterprise value number from that, not considering that like all of those multiples need to be justified. Then you're not even thinking about like, well, how does that convert to free cash flow? What are the CapEx needs, et cetera, of each of those businesses? And so you get this sum of the parts number that makes no sense. And then, you have a bad investment analysis, in my opinion. Where I think some of the parts can go well is if the sum of the parts has to be in addition to something else that's going on. So it's in addition to a core free cash flow growth IRR story that exists, like you have with BAT. Then like this other part that's not getting valued is just like the cherry on top, right? And so that's kind of how I view it. Like the sum of the parts has to kind of confirm what you already suspect about the DCF value, and in those cases, it can work. But otherwise, all that means is if you're going to slap 20 times EBITDA on some segment, you need to show me how the free cash flow growth in that segment is going to justify a 20 times EBITDA multiple. You know what I mean?
So I do hear you. I think to me, it's hard for me because like, let's just use Comcast, right? Comcast, let's simplify it. 2 segments, a media segment and a cable segment. And I think a lot of people look at it and say, media, let's pick media worth 10, cable worth 5, put it together. That's your enterprise value. And I think that's actually technically correct, right? Like that's how they do. I think the 2 things that to me get missed most often is they forget about the corporate overhead. Everybody loves to present the sum of the parts and everybody always forgets about the corporate overhead. And I chose Comcast for a specific reason on the fly. And that's because they also forget about the conglomerate discount, right? Where, a Comcast, everybody's terrified of the next deal Brian Roberts is going to do. And Brian Roberts controls that with a pretty iron fist. And, I know you had a lot of success with, kicking myself, Meta in November 2022, right? And I think part of that success is it was crazy cheap, but people forget November 2022. I do think people did think some of the business was terminal. They were worried about the spending on Meta Labs, but a lot of it was Mark Zuckerberg. People were playing a huge conglomerate discount on Mark Zuckerberg because he controlled it, and people were worried he was going to increase spending on Meta Labs from 16 billion to 160 billion or something, right? And I think people forget like a big part of it is the conglomerate discount, and a lot of some of the parts can be getting the conglomerate discount taken away, in Michael Dell's case, in Meta's case, getting the conglomerate discount that maybe is partly rightly signed, but it's way overblown, or it's about to get removed, it's about to change. In Mark Zuckerberg's case, it's going to go to a premium again. Like I'm just rambling, but that's kind of my
I think that type of story can work. Even I think it can work when you properly analyze the individual segments and you don't mess up the corporate overhead. And that's one of the reasons why I force myself to bring it down to free cash flow at the enterprise level, because you can't, that way you don't miss things like that. And then if you are long something that has that conglomerate discount but you do still believe in the free cash flow forecasts, you're just constantly long an option that the guy's not an idiot, right? Like you're constantly long an option that Zuckerberg wakes up and says, wait a second, why am I growing expenses 30% when my business is stagnant this year? Like maybe I should cut some employees. Maybe they don't all need to get lattes for 2 hours in the afternoon, and we can just have everyone work from 9 to 5. Like, you know what I mean? And so you're constantly long that option. Or actually, one that worked for us was Fox back in the day, and that was a sum of the parts story. But you could pencil it out in terms of free cash flow. Like they really did have they really did have some growthier segments that that deserved a decent multiple, and you were long an option that Rupert Murdoch decided to do something smart, and in that case the option paid off.
You are the one man to have made money on the Fox stock, if that is the case, because it's always got that sum of the parts. It always looks cheap, and it is.
Well, this is the pre Disney sale Fox, obviously.
Okay. I was thinking Fox. No, that's a great point. And look, Rupert Murdoch, God, that was quite the bidding war too. Rupert Murdoch finally got religion on that.
Like all the best investors, Fundamental Edge believes that the learning process never truly ends. That's why the Analyst Academy is just the beginning of their journey with you. Fundamental Edge alumni gain access to exclusive content, such as their guest speaker series. It recently featured TED CDs of capital allocators. Alumni can also look forward to frequent webinars, case studies, and content from industry partners. For job seekers, there's the Talent Hub, which helps both Academy graduates and other buy-side candidates connect with top funds looking to add new analysts. Alumni, including students enrolled in the upcoming January cohort, are also invited to the inaugural Analyst Spring Training Conference coming up this spring in Scottsdale, Arizona. Attendees will engage in numerous learning sessions while building their buy-side networks, and then they'll enjoy some spring league baseball and the amazing Arizona weather. If you'd like access to all that Fundamental Edge has to offer your career, visit fundamentedge.com for more information about the next Academy cohort. That's fundamentedge.com.
Let me just ask one last question, turning it back to bats. Huge free cash flow, pay out a ton of dividends. However, I think they've also been kind of clear that they want to do some strategic acquisitions. They might want to buy some brands and that type of stuff. And when I see tobacco companies saying, I want to do anything other than return capital to my shareholders, I get a little bit nervous, because I think the history of tobacco company is they produce unbelievable cash flows, right? If they return it to shareholders, you're going to do great. If they go buy if the number 3 company buys the number 4 company, synergies out the wazoo, you're going to do great. Anything else, and it's going to be a disaster. And anything else can be Philip Morris invested in Juul at the absolute top of the market. Anything else could be in the 80s, all these tobacco guys saying, we've got tons of cash flows, let's go buy RJR Nabisco, let's go buy movie studios. You can look at, but anything else. Now they're saying they want to do strategic stuff, and I think if I had to guess, 80% plus of free cash flow is going to be returned to shareholders. So maybe I'm seeing my own shadow here, but just want to ask you, how comfy do you feel? Because when you're buying something at less than 10x free cash flow, a lot of it is just the free cash flow return story than anything else. So how comfy do you feel with all that?
Yeah, I mean, that is the one nice thing about a dividend, is even if it's not completely economically rational, the companies feel pretty tied to continuing it and growing it over time. So like you said, that basically accounts for it's probably 60 to 70% of their of their free cash flow. And yeah, I mean, if you told me that they were going to take the rest of it and go buy, really do any acquisitions, I really don't want them to do acquisitions. You're probably unsurprised to hear me say that would definitely ding my forecast somewhat, because I think they should probably they can get like risk-free 6% roughly by just buying back their debt, or just or paying down their debt as it comes due. So that would be the other thing that I would want them to do with the money, and they have talked about doing that as well. But yeah, please don't let them do anything stupid.
Isn't it crazy how the world changes? Just 2 years ago, I mean, a lot of their debt is fixed costs. So one of the funny things is with this, or a lot of the big companies that are, maybe their stock prices are down over the past 2 years, a lot of people look at them and say, oh, they've got debt trading for 60 cents on the dollar, they're in distress. It's like, no, dude, they issued 25-year debt at 2%. Like, it's trading at 60 cents on the dollar because they did a great job. But it's just so funny. 2 years ago, you and I would have never said, hey, taking cash flow to pay down risk-free debt is a good idea. But today, I mean, I think it would probably be better to shareholders to dividend it out and just return it to them. But it's an argument, right? You lengthen the runway, lower that interest burden. taxes across the board have probably come down, so you don't get as much of a tax shield from them anymore. But cool. Evan, anything else you want to talk about with British American Tobacco?
No, that's it. Yeah, I think this is we pretty much ran the gamut on this thing.
And as I'm thinking of it, I think this is actually your 4th podcast appearance, and I said 3rd at the start. And 5th podcast appearance, you get the yet another Value Blog T-shirt. So,
okay. All right, I'll have to come up with more good ideas and or more. I don't know if they're good, but ideas.
Just more ideas.
I've got ideas. I've definitely got ideas.
Well, look, the British American Tobacco write-up is fantastic. There's going to be a link in the show notes, so I would encourage anybody who wants to read a really good write-up to follow that. Reach out to Evan. Evan, I'm looking forward to the 5th podcast. You're going to get a shirt from it. I'm going to wear your hat for it. So we'll go from there. But Evan, thanks so much for coming on. Looking forward to chatting soon.
Thanks. Same to you.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.